Well, as we just showed you, shares of MEG Energy are up in a big way. This follows the announcement of a proposal, a takeover proposal that would include stock and cash coming from Strathcona Resources. Let's get some perspective on this and other topics in the markets today from Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks a lot for joining us. This, as you probably know, is being described as a underwhelming offer from Strathcona, a premium of only 9% for MEG Energy. What are your thoughts on this proposal?
Well, I think it's fantastic. I think the industry needs a shakeup. We need to get things going. There's a huge overhang regards to tariff concerns, pipelines, emissions cap, weaker oil prices. And I think there's some huge upsides as what we're seeing today in response to MEG. These companies are tremendously undervalued, and there's some room for consolidation. So I say good on you, Adam Watrous, for getting things going here. And hopefully it results in more consolidation and unlocking some untapped value in many of these names here.
What has been the problem at MEG? The share price has been disastrous over the past year.
Well, again, the tariffs, it's been a go-to for hedge funds in the U.S. to short on concerns over tariffs and exports into the U.S. It's very similar to Cenovus in regards to its project at Christina Lake, and you can see Cenovus has been an underperformer as well, too. And so that's been an overhang on the company. Now, fundamentally, it's still a great company. It's got a 35-year reserve life. Free cash flow is like 10% around current oil prices, maybe a little bit lower. And so it's got, it met its debt targets and it's doing share buybacks. And so from a long-term investment, MEG is really an interesting one to keep an eye on. And we do own it, and fortunately. And so as you can see today with Strathcona putting it into play, a nice 17, 18% rally in the share price.
Okay, you at this juncture prefer, for your energy exposure, pipeline companies and infrastructure companies rather than the producers, correct?
Yeah, we still own C&Q in size. It's got a nice 5.2% dividend. We do own MEG because, as I just mentioned about the fundamentals and its long life reserves, we do own a little bit of Cenovus. But if you're looking in the energy space, as looking at safety and protection, because we do think there's going to be some weakness, continued weakness over the next couple of months on the U.S. consumer demand for energy. OPEC is bringing on new barrels onto the market. And so besides the names I just mentioned, we like some of the pipeline companies. Like Enbridge is 7% dividend yield. TC's got 5%. And so maybe not a lot of growth, but those are some nice dividend yields.
Okay, let's broaden out to other sectors of the Canadian equity market. You like the banks as well, and they have done very, very well recently. We can perhaps put up a graph of the TSX banking index. It has gone up in a big, big way over the past month or so. Why do you like the banks at this juncture?
Well, we've benefited from this rally here. They've got also some nice dividend yields. We have been a little bit more cautious now and trimming some of that back, moving into some of the names that have some U.S. exposure, more U.S. exposure like BMO or TD. TD's got a 4.6% dividend yield. We like those with more U.S. exposure because we are concerned about the Ontario housing market and maybe some potential for defaults on mortgages and how that's going to impact those Canadian banks over the next couple of months. There's a lot of mortgages coming due in Canada that were financed during the low rates from COVID. And then with housing prices falling actually dramatically from 2022, compared with higher mortgage rates, there could be some weakness for the banks. And so for the Canadian banks, so we've been taking some profit, repositioning into some that have exposure to the U.S. market or U.S. economy that's stronger.
Is it counterintuitive, Martin, for the Canadian bank stocks to be rallying so dramatically at a time when there's so much uncertainty facing the Canadian economy?
Yeah, but there may be some positioning around fear of missing out because they have rallied, but also with falling interest rates, they will benefit from that as well. And so, looking at the Bank of Canada and what they've signaled, we think there's greater potential for falling rates in Canada than in the U.S. And so maybe investors are positioning around that. We're just looking at it, taking the opposite point of view and saying, okay, maybe it's time to take a little bit of profit in some certain banks with more Canadian exposure and repositioning into some other areas, like I said, pipelines, but telecom's also been really beaten down. And so taking some profit from the banks and rebalancing into other segments that offer more maybe potential stability.
That's Martin Pelletier. We will have Martin stick around for another conversation. This time we'll focus on the U.S. stock market right after this.